What if the most powerful mortgage safety net isn't on the homepage? Because it's designed to protect the bank, not you. We're talking HELOCs and payment deferrals, the relief tools lenders classify as hardship. I'll show you how banks manage risk quietly while you carry the long-term cost, how mortgage insurance and down payment rules shape your options, and how to ask for flexibility without triggering the wrong internal notes. If you're a first-time buyer in Canada planning for turbulence, you're in the right place. Before we move on, please take a moment to subscribe to the channel and like the video. Banks call it relief. Your wallet calls it oxygen. But the reason it's buried is simple. The math pays them first. Deferrals and HELOCs look like lifelines. They're also toll roads. Every turn adds a fee, and you don't see the meter until the bill lands. Let's break it down. The loud stuff is cute and friendly. FHSA accounts, the home buyer's plan, provincial land transfer rebates, front page, confetti, big fonts. The quiet stuff sits in the back office. Payment deferrals and HELOCs. These aren't sold with balloons because they aren't freebies. They are structured revenue with risk labels attached. You hear deferral and think free pass. But here's the catch. Interest keeps accruing while the clock is paused. Your amortization stretches. Your total interest cost rises. And inside the lender, your file can pick up a hardship code that follows you like a coffee stain. It won't scream at you today. It whispers during renewal and refinance when the rate offer comes in a hair worse than your friend's. Think of a deferral as a pause button that adds frames to the movie. The show doesn't stop, it grows. And your ticket gets more expensive because you're paying for the extra runtime you didn't plan for. That's the quiet tax of convenience. Now stack what you already pay. Default insurance premiums scale with your down payment bracket. 5 to 9.99%, 10 to 14.99, 15 to 19.99. Each step up changes the premium load baked into your cost. Add a deferral on top, and you're compounding interest on a larger balance for longer. And with 2024 rules cutting off default insurance on homes over 1 million, there's no insurer backstop on those properties, which means higher stakes and fewer cushions if you need relief later. Zoom out to 2024 through 2026. The shared equity experiment is gone. No FTHBI safety narrative. So what do lenders lean on? Risk tools, not hand-holding. Internal flags, internal scorecards, and products that float at spreads. Quiet levers keep default rates steady without splashing moral hazard across the homepage. You won't see a banner for Hardship Coding 101. You will see an offer to talk options. Let's get real with a simple run-through. You buy with 5% down, fresh job, probation period. 3 months in, you hit a cash squeeze and ask for a deferral. The lender can grant it, but your interest keeps running. The effective amortization creeps, and the file can tick into a higher internal risk grade. Fast forward to your refinance window. You don't get the hero rate. You get the we remember rate. So how does the bank make money on relief? First, interest accrues during deferrals and quietly lifts your lifetime interest bill. Second, HELOCs price at Prime Plus. Spreads move. Prime moves. Your borrowing cost can float right into more revenue. Third, once you're on the hook for a line, cross-selling kicks in. Cards, protection insurance, bundled accounts. Each slice adds to the relationship margin. Here's the mini payoff. Ads exist to pull you into the funnel. Relief exists to keep you in the system longer at a higher lifetime interest tab. That's why the homepage screams about rebates and savings accounts, while the real flexibility lives behind a phone queue and an advisor who's trained to log every keyword. So if that's the business model, the play is obvious. You need flexibility without lighting up your file like a Christmas tree. You want the oxygen without the siren. And that starts with how you set up the credit before the storm and how you ask for help when the wind picks up. HELOCs are the Swiss Army knife banks keep in the drawer. Flexible. Fast. But here's the catch. When first-time buyers use them the wrong way, they broadcast one word to the lender: hardship. Used right, they're a stealth parachute you pack on day one and forget about until you actually need the glide path. Here's the quiet path. You get pre-approved. You line up your FHSA and HBP for the down payment. Then you layer in a modest HELOC limit or a re-advanceable mortgage structure. Not a shopping spree. A small, disciplined line that grows as you build equity. Many lenders want solid credit, stable income, and a sane debt-to-income ratio. Some will only unlock a HELOC when you've got around 20% equity, and standalone lines can demand even more. Re-advanceable setups can attach a small revolving piece sooner. But again, this is about control, not capacity. Now the tension. Ask for a payment deferral too early or start sending EI paperwork outside of context, and your file can pick up a hardship note. That tag doesn't yell today, it lingers. Renewals, refinances, internal rate offers, everything gets filtered through that lens. Lenders track servicing behavior. A deferral code is data. Data follows you. Deferrals aren't vending machines. They're situational. Job loss, medical, income shock. Lenders can ask for proof, and once your account is coded, internal scorecards may move you into a different bucket. That's why timing and language matter. You want to request options tied to performance. On-time payments, equity growth, limit reviews, not emergency relief. Same conversation, different signal. Let's talk EI as the bridge. If you qualify, EI can cover a slice of income during a gap, subject to eligibility like recent insurable hours and waiting periods. Lenders see EI as temporary. In underwriting, it's not a forever paycheck. In servicing, it can be part of a plan if your payments keep hitting on schedule. So the move is simple. You line up EI, you line up a small HELOC, and you automate your mortgage payment from a funded account. The bank sees continuity, not crisis. Working example. You close with 10% down on an insured mortgage. Before turbulence, you open a re-advanceable component or a small HELOC limit. You treat it as a 3 to 6 month runway. Mortgage payment auto debits. If your income dips, you draw just enough from the line to top up the account and cover the payment. You pay interest on what you use, and you stay current. No deferral flag, no hardship note. Your internal profile looks boring, in a good way. Contrast that with the scramble. You skip the contingency. Mid-probation at a new job, you ask for a deferral. You get the pause. Interest keeps piling. Your amortization stretches. And the file can carry a servicing caveat into your next renewal. The lender remembers, and your negotiation leverage shrinks when you need it most. So how do you ask without setting off alarms? You script it. You're requesting a limit review or re-advance based on-time payments and modest equity build. You're confirming product features, not declaring distress. If income softens, you use EI and the HELOC to bridge the shortfall and keep payments automated. You only pull the deferral lever if every other path is closed. That's your mini payoff. Build liquidity early. Frame requests around performance. Keep the record spotless. Now let's run this playbook through the 2026 reality. Stickier rates, insurance cutoffs at the high end, and provincial rebates that quietly stretch or shrink your runway.